Imagine waking up one morning to discover that your monthly mortgage payment has gone up. The loan didn't change. Your house didn't change. You didn't borrow more money. And yet, somehow, life just became more expensive. Across town, someone else decides not to buy a new car because the monthly payment suddenly feels too high. A small business owner cancels plans to open a second location. A company delays hiring new employees. The stock market drops. Home prices begin to cool. None of these people know each other, but they're all reacting to the exact same decision. A decision made in a meeting room hundreds of miles away, by people most Americans will never meet. That decision? Changing interest rates. It sounds like one of the most boring topics in finance. In reality, it's one of the most powerful forces shaping your financial life. Because when interest rates move, they quietly influence almost everything. Your mortgage, your credit card, your car loan, your savings account, your investments, even your chances of getting a job. And yet, most people only hear one sentence on the news. The Federal Reserve raised interest rates. Then the story moves on. But what actually happened? Why does one small percentage point have the power to ripple through an economy worth trillions of dollars? To answer that, we need to start with a simple idea. Money has a price. That sounds strange. We think about the price of coffee, the price of gas, the price of a house. But very few people think about the price of money itself. Interest rates are simply the price of borrowing money. Imagine your neighbor asks to borrow $100 for a year. If they return exactly $100, borrowing was free. If they return $105, the extra $5 is the cost of borrowing. That's interest. Scale that simple idea from two neighbors to an entire country. And suddenly you're looking at the financial engine of the United States. Now enter the Federal Reserve. Contrary to what many people imagine, the Federal Reserve doesn't directly tell your local bank exactly what mortgage rate or credit card rate to charge. Instead, it influences the cost of money throughout the financial system. Think of the economy as a giant city filled with roads. Money is the traffic. Interest rates are the speed limit. Lower the speed limit too much and traffic barely moves. Raise it too much and everyone slows down. The Federal Reserve is constantly trying to find a balance where traffic flows without creating chaos. Easy in theory. Almost impossible in practice. Let's imagine money becomes incredibly cheap to borrow. Businesses rush to expand. Families buy bigger homes. Consumers spend more. Investors borrow money to buy stocks. Everyone feels richer. Economic growth accelerates. Sounds perfect. Until too many people start chasing too few goods. Factories can't produce fast enough. Workers become harder to hire. Demand rises faster than supply. Prices begin climbing. Inflation appears. At first, inflation doesn't seem dangerous. $5 becomes $6. A $10 lunch becomes $12. Most people barely notice, until they realize their paycheck hasn't grown nearly as fast as their expenses. Now the Federal Reserve faces a difficult choice. Do nothing, and inflation may continue spreading, or make borrowing more expensive. That's exactly what raising interest rates does. Higher interest rates encourage people to borrow less. Companies delay projects. Families postpone purchases. Investors become more cautious. Demand begins slowing. Eventually, price increases begin slowing too. It's a bit like cooling down an overheating engine. The goal isn't to stop the engine. It's to stop it from catching fire. Here's where things become surprisingly uncomfortable. When the Federal Reserve raises interest rates, it's intentionally making parts of the economy slow down. Sometimes that includes hiring. Sometimes housing. Sometimes consumer spending. Why? because slowing demand can help reduce inflation. This creates one of the strangest paradoxes in economics. Good news for inflation can sometimes feel like bad news for families. Higher interest rates often mean more expensive mortgages, higher credit card payments, more expensive business loans, companies becoming more careful about hiring. Growth becomes slower by design. Nobody enjoys this. Not consumers, not businesses, not politicians. But allowing inflation to spiral can be even more damaging. History offers painful reminders. When inflation remains high for too long, prices begin changing so quickly that planning becomes difficult. Businesses struggle to predict costs. Families struggle to budget. Savings lose purchasing power. Confidence weakens. Money itself becomes less reliable. That's why central banks often accept short-term pain in hopes of avoiding much larger long-term problems. Of course, interest rates don't stay high forever. Eventually, inflation begins cooling. Economic growth slows. Sometimes too much. Businesses invest less. Consumers spend less. Unemployment begins rising. Now the Federal Reserve faces the opposite problem. If borrowing stays expensive for too long, economic activity can stall. So rates may eventually fall again. Cheaper borrowing encourages spending. Investment returns. Hiring improves. Growth accelerates. The cycle begins again. Notice something interesting. The Federal Reserve is almost never trying to make everyone happy. Its job is often about choosing between difficult options. Raise rates too slowly. Inflation stays high. Raise them too aggressively. Economic growth may weaken. There's no perfect answer. Only trade-offs. And that's why financial markets react so dramatically after every Federal Reserve meeting. Investors aren't just watching today's decision. They're trying to predict tomorrow's economy. A tiny change in interest rates can influence trillions of dollars in investments because it changes expectations about everything else. Housing, technology, banks, employment, corporate profits, consumer confidence. Almost every financial decision begins adjusting. The remarkable part is how invisible this process feels. You don't receive a letter saying your future just became slightly more expensive. Instead, you notice your mortgage quote, your car payment, your savings account earning more interest, or your business loan becoming harder to justify. One decision quietly spreads through millions of lives. And perhaps that's the most fascinating part. The Federal Reserve doesn't build houses. It doesn't manufacture cars. It doesn't hire workers. It doesn't own grocery stores. Yet by changing the price of money, it influences every one of them. Which leaves us with a question worth thinking about. If one institution can influence borrowing, spending, investing, hiring, inflation, and even the pace of the entire economy, is money simply something we use? Or is the price of money quietly shaping almost every financial decision we make without us ever noticing?